If you spend your day watching CNBC and you consider that investing, you're probably doing it wrong. What does Buffett do? He spends his days reading, annual reports instead of focusing on all the numbers that are flashing across the screen on CNBC. I often tell clients that I'm a recovering mutual fund manager. My family wasn't overly wealthy, but I was always very interested in learning more about investing in the markets. I got a call from Neil Kashkari at PIMCO. Ultimately, that led me to a job on Wall Street. Dividend world, there's kind of two flavors, right? There's the high yielders and then there's the dividend growers. We find companies that have 1 or 2% dividend yields that it doesn't sound that exciting, but they can be really exciting if they're growing at a 20+% a year. I have most of my own liquid net worth invested in dividend paying equities. Passive investing has all these followers because it's supposed to be magic formula for success in the markets. What most people miss, it's only the magic formula if you stay invested through thick and thin. Dividends over time and compound capital, stay invested. You're going to do great over time, and the earlier you start, the better.
Investors, welcome back to another go-round of Masters of the Market. Now this week, I am incredibly excited to have on with me Austin Graff, who is a founder and CIO of Opal Capital, here to talk all about dividends and investing on a financial freedom journey for us all. So Austin, welcome to Masters of the Market. I actually want to throw the first question right over to you and get right to it here. Ask you about your story and how you got to where you are today.
Yeah, thanks for having me, Ari. So it's actually goes back to kind of when I was in business school. I worked for the state of Indiana, and at the state of Indiana, it was one of those jobs that no one really wanted to take, but I needed to pay for business school. So I took an assistantship that no one else would take, and I was fortunate because I ended up working on the two biggest deals the state had ever done. We financed the Lucas Oil Stadium, which happens to be where the Indianapolis Colts play. And we also sold a 75-year lease on the Indiana Toll Road. And those sound like pretty boring transactions, right? They're big, but they're really boring assets. Ultimately, that led me to a job on Wall Street because not many people knew about this esoteric business called municipal finance or infrastructure investment banking. It was relatively new, or the infrastructure banking side was new in the U.S. As I was leaving school, I sent my resume around to a bunch of banks, and it just happened I got a job at Goldman working on infrastructure M&A team that was primarily investing some private equity infrastructure funds that Goldman had raised. So I spent the first few years of my career really focused on the most boring of boring assets, right? These are GDP plus growers. The way you generate amazing returns, at least before the global financial crisis, was by levering them up. We would buy assets, we'd put 30 times EBITDA leverage on them, and then we'd go and improve operations, and it would generate good returns for investors. And then the global financial crisis of 08-09 came, and everything that had grown for 30 years at some multiple of GDP all of a sudden stopped growing, and we had a lot of leverage on them. So it put us in a unique position. We were working a lot of assets out, dealing a lot with the banks, trying to figure out ways to keep our equity stake, but also keep the banks less upset with the situation. So it was a great experience at a relatively young age, but it put me in position to join a financial institution's restructuring desk at Goldman because we were at a place where banks weren't lending to us anymore. In kind of 2009, 2010, 2011, the funding market had seized up, so helping banks and insurance companies work out their asset portfolios was really interesting. I also learned a lot about banks in the process, right? Like how they do accounting, how they think about investing, how they think about funding their balance sheet. And then QE came along in about 2011, and the banks were like, yeah, that was great to have all that help, but no thanks. We don't need you to come buy our assets at pennies on the dollar anymore. We'll just hold on to them. So there wasn't much to do. I got a call from Neil Kashkari at PIMCO saying, hey, I'm starting this global dividend team. They had lifted out a team from Thornburg Investment Management. Neil was looking to add another member of the team, so I joined the team. I went from Goldman to PIMCO. Started out as just an analyst on the team and rose pretty quickly to be a named PM. We grew that business to about $5 billion in assets. We had a 5-star Morningstar rated fund. We focused on global dividends, U.S. dividends, international dividends, and also some allocation products. That was great. I was still relatively young as a named PM at PIMCO in my early 30s, and I kind of looked around and said, what do I want to do with the next 30 or 40 years of my life? It wasn't necessarily finding a way to make PIMCO more money. I was looking to get closer to investors, and so I just decided one day to leave PIMCO. It was a unique decision for that point in my career. It's one of those things that I'd worked for a long time to become a named PM, and as soon as I got it, I was like, there's got to be something else out there. And so we eventually worked with a lot of RIAs, helping them think through their investment processes, sitting on investment committees, and got to a point where some RIAs asked me to launch dividend strategies. And so we started with SMAs and then turned that into a dividend-oriented ETF with the ticker DIVZ. And now we're actually in the process of launching an international dividend ETF as well.
So first of all, quite the journey. Second of all, you're the perfect person to have on Masters of the Market, a dividend specific channel talking all about dividend investing. But before we get to all the dividend talk, I actually want to go back to your earlier years real quick and just ask you about your inclination or your motivation to dive into the financial world. Has it always been there? Or?
Yeah, I grew up in a small town in Wisconsin. And this was at a time when, the dot-com craze was going on. I was in high school in kind of the late 90s. I think I was a junior with Y2K, right? It was before everything had blown up, but I was always very interested in learning more about investing in the markets. My family wasn't overly wealthy. They weren't really focused on the markets. It was just something that interested me. And so when I went to school, I tried to get as much exposure as I could to different types of investing. And that led me down a lot of different paths while I was in undergrad and business school at Purdue. Ultimately, I didn't expect to be a public market investor. Most of the time you go to be an investment banker and you become a hedge fund manager or a private equity manager of some type. And I thought that was the route I was going to go down from being a investment banker at Goldman. And until the job came, that was presented to me, then I was like, wow, this actually makes a lot of sense. I can translate all this work I've been doing in the private markets, all the work that I've been doing in the C-suite or the boardroom, meeting with management teams, into something that helps a lot of people rather than a very narrow section of the population, which is what you tend to help when you're in one of these private vehicles. So I think it's a unique way to deliver kind of some of the institutional skill set to a broader swath of the population, because everyone can invest. I view ETFs as a great kind of democratization of finance in a way that mutual funds couldn't get it done, right? Mutual funds, I often tell clients I'm a recovering mutual fund manager because mutual funds are so bad for underlying investors. And when you really understand the difference between mutual funds and ETFs, it's unbelievable that the SEC allows mutual funds to remain in existence. But that's another kind of topic. That's kind of how I got into it. I've been really interested and focused on investing since I was a teenager, but there wasn't I didn't have someone when I was really young kind of direct me down the path. I was more interested because it was a topic of news, and then I developed kind of mentors who didn't know they were mentors, like reading all the Buffett materials, obviously Munger, and then trying to get my hands on every book I could about investing, while also getting very deep experience as a banker on fields that just happen to be great fields for dividends, right? So becoming an expert in some of those fields really helped out. If you think about how Buffett and Munger talk about circle of competence, I was able to develop that circle as a banker, which is a unique approach.
So you caught the bug. Not only did you catch the investing bug, but more specifically, eventually the dividend investing bug. Now, before you got into the world of Wall Street and finance, were you dabbling in dividend stocks before? Because a lot of people would argue that dividend investing is just boring. And a lot of people want to jump into growth stocks, but you have a young buck like yourself that was just getting started with dividends, and even now where you're at with Opal, still dividend oriented. What's the deal with dividends? Why not go into the growth stock orientation?
It really comes back to personality. And, I grew up in a blue collar area, right? Where everything comes back to prove it, prove that you're worth what you're worth. And so you're like, okay, I can see a dividend. It's very tangible. I can discount it. One of the things I really had a hard time with moving from infrastructure to financial institutions and other kind of sectors is when you finance infrastructure, you see the product when you're done. It's kind of cool. You do, like, you go finance a new terminal at LaGuardia. When you're flying to New York and land in LaGuardia, you're like, man, I contributed to this. It's cool. Like, working on the stadium financing for Lucas Oil Stadium, right? Like that's nice because people understand what that is. And then you go into other areas and you get into this like more esoteric, like, yeah, I bought a bunch of loans from a bank and I got them at 30 cents on the dollar. And it's like, okay, well, that's interesting. Like, what did you actually do? Well, it's 5,000 homes that were financed. It's like, well, where are the houses? And it starts turning into like, from something that was very tangible and interesting because you can like put your finger on it to something that's more abstract. And I feel like dividend investing has a lot of those tangible characteristics where it's like, okay, it's something that I can come up with a valuation on because it's generating cash flow, it's returning some of that cash flow to investors. The management team tends to have they tend to have a preference for doing this rather than trying to reinvest in the company and trying to compound growth over time. And I think that there's a lot of commentary, especially from some of the folks like Buffett, who's like, I don't want to pay a dividend because of the tax consequences. And then you look at every company that Buffett owns, and they pay dividends. And it's from an accounting perspective, it's really easy to fool people, but it's hard to fool them when you're dealing with tangible cash flows. And so I think that you can get away from some of the accounting manipulation by focusing on these more tangible qualities. And then, just naturally from a blue collar Midwestern background, I'm not the guy who's going to go out there and try to tell you, what some Silicon Valley company that's like pre-revenue is going to be worth in 5 or 10 years. It's just not how I was raised, and it's not my mentality.
Humble beginnings. Humble midway through here, and maybe eventually another Buffett on our hands with the mentality.
I doubt it, but yeah.
I want to ask you about the process of getting started. So we'll dive into the investing talk before we get more into Opal Capital. Let's take an avatar of somebody in their early 20s, another one in their 30s or 40s, and we're just looking to get started in investing. How do we start? What's the best way to approach investing? Is it through ETFs? Is it in fact through dividend stocks? Should we go all in on growth?
I mean, it really depends on your mentality, right? Like if you look historically, 92% of returns come from two things. It's earnings per share growth and dividend yield. And so you could take your choice. If you want to be a growth investor, that's fine. I think, it's smart if you're a growth investor to think about the price that you're entering at, because you could turn into the guy who bought Microsoft in 2001 and it took 14 years to get back to even. Whoever that was, that avatar, he had to have a hell of a lot of mental fortitude to hang on to that stock for 14 years, waiting for that to come back to even. It's really a learning experience on what your mentality is and what you're willing to live with from a volatility perspective. That being said, a 20-year-old, you can't go wrong with dividends, in my opinion. You could argue about taxes. But I think if you're going to go with dividends and just reinvest those dividends over time and compound capital, stay invested, you're going to do great over time. And the earlier you start, the better. 30 and 40-year-old, I would say the same thing. I have most of my own liquid net worth invested in dividend-paying equities. If you want to be in the growth investment side of things, like that's fine, and it's definitely an effective route to go. I think where valuations are today, you have to really be confident in the growth numbers that you think you're going to achieve. But more importantly, you have to have the mentality, and more so in a growth portfolio than a dividend portfolio, that if the stocks are down 30, 40, 50%, you're not selling. You're holding and you're waiting. You're definitely understanding what you own and more excited about low prices because you can buy more than you are upset because the number in your portfolio or the value of your portfolio has gone down. It's actually the price of your portfolio has gone down, right? And so a lot of investing comes back to mentality. I think that passive investing has all these followers because it's supposed to be, basically the magic formula for success in the markets. What most people miss, it's only the magic formula if you stay invested through thick and thin. So I think it's really funny when people are like, "Oh, you're an investor. I own, the S&P index, but I'm concerned about the market, so I sold half of my portfolio and I'm holding it in cash. What do you think I should do?" And you're like, "Well, you missed the other half of the passive conversation, which is you got to own the market because no one can really tell what is coming over the next 3, 6, or 12 months." And so it really comes down to what's your mentality. If you're going to freak out every time you see a small blip in your account, I would strongly urge you to be a dividend investor because there tends to be more downside protection. And we can talk about what types of dividends tend to provide more downside protection. But if you're gonna, be excited when your portfolio is down because it gives you the opportunity to buy more at a lower price, then by all means, hop on growth names and be selective in owning names that you think can truly come through with the growth estimates.
Let's talk about this mentality that you're referring to, right? You need to have that mentality. Is there a way that the mentality to be a successful investor, I'll say, can be developed?
Everyone talks about experience as like the only way to really develop this, and it's cheaper to learn a lesson by reading a book than it is to lose money in your own account. I think there's some combination of the two because often you can read a book but not feel the pain, right, that you feel when you actually lose money. So I think a lot of it comes with experience and just understanding your personal disposition. I'm a pretty laid back guy. And so for me, when I think about things, it doesn't really upset me that much if the portfolio is down a little bit, also because I understand the fundamentals in the portfolio and I have the ability to make decisions based on underlying fundamentals. And a lot of people have come up to me, especially when we're at PIMCO managing billions, and they're like, "I would lose my mind if the portfolio was down like 5% because you start thinking about what that means on a couple $1 billion. It's a lot of money." And I'm like, "I'm sorry, that thought had not even entered my mind, and I hope it never comes back." Because when you start making decisions out of fear or out of other emotional kind of constructs, you're not necessarily going to make the best investment decisions for your clients. So it really has to come back to rational thought process, and you need to bring it back to the fundamentals and scientific reasoning as much as possible.
Now, dividend specific wise, when we're getting into dividend investing, a lot of people immediately go towards yield. And before we even get into tax, because you mentioned another great point just a minute ago about getting into the taxes of dividend stocks, which is also something a lot of people are concerned about. But dividend yield up first here. So many people flock to yield, but it's also concerning because there's the classic yield traps that are out there. How do we know what's a yield trap, how to avoid them, and if we're avoiding the yield traps, does that mean we're just going for dividend yields, below, 2%? Because then on the other end, people are like, it's nothing. Why would I even invest in that company?
Yeah, and in dividend world, there's kind of two flavors, right? There's the high yielders, and then there's the dividend growers. And you hit on the issue because the high yielders, they're paying a high yield often for a reason. Usually those are going to be super cyclicals. They're going to be high levered companies. And you get a 7% yield the hard way. It's in the U.S. in particular. You can get some high yielders internationally because they have different dividend dispositions, but we're speaking for U.S. investors. And then you have these dividend growth portfolios. And it's really interesting because in the dividend growth world, people tend to talk about yield and costs after holding for 10 years, right? So they're like, "Yeah, I'll give you a 50 basis point yield today, but in 10 years, after 20% annualized growth in the dividend, your yield on cost is going to be like 4%. And it's like, well, how many people are holding on for 10 years? Not that many. When you think about the names that provide the most stability in a down market. It actually tends to be the dividend growers over the high yielders. The high yielders being the cyclical or super cyclicals with, questionable balance sheets. When bad things happen in the economy and the market, those tend to be a place where people go to sell, right? They tend to be a source of cash for people. So they go sell those things, raise cash. It tends to not be the place you want to be. There are a lot of people who believe that, high yielders are a great downside protection because they think the dividend yield is what's protecting them. I don't think that's right. If you actually look at the data, dividend growers are what provide the downside protection because they tend to be tied to higher quality businesses with better balance sheets. And so when we look for dividend payers, we're looking for high quality companies, attractive returns on equity and capital, really clean balance sheets. And the most important thing is we want a significant headroom on free cash flow to the dividend payments. Usually we're looking for about 100% higher free cash flow to the dividend payment, or about the dividend being about 50% of free cash flow. And when we're looking at that, we're looking more at maintenance CapEx instead of looking at total CapEx, which allows us to invest in some utilities and whatnot that you wouldn't use with a more simplistic view of free cash flow. But our view is if you have a management team that's committed to paying a dividend and you have a company that tends to have more stable free cash flows and they have significant free cash flow in excess to the current dividend payments, you're in a pretty good spot to continue to have attractive and growing dividend payments. Now, we think that there are great opportunities in the low yield, high growth space, and we think there are also great opportunities in the higher yielding, slower growth area. And what we do in our ETF and our SMAs is we kind of combine the two to give investors the best of both worlds. So we're giving them a 3+% yield that's growing somewhere in the mid to high single digits a year, which we think is kind of a nice sweet spot for investors.
I want to talk to you a little bit more about this dividend yield range that would be ideal for dividend investors. If you can hit that nail on the head for us, like what is the ideal range that we should be looking for where it's enough safety, where we really, as dividend investors, we want to sleep at night, not toss and turn, worried about either a yield trap, anything happening in the market. So that comes with, like you said, a healthy balance sheet, and that healthy balance sheet produces the dividend. What's the yield range that we really should be looking for?
It depends on the company, right? And what they're actually, what their underlying business is. We find companies that have 1 or 2% dividend yields that it doesn't sound that exciting, but they can be really exciting if they're growing at a 20+% a year. And then we also have companies in the portfolio. I mean, we had one company with nearly double-digit dividend yield. And when we looked at their free cash flow and we looked at the underlying businesses, we're like, well, they're generating over twice the free cash flow that they need to service the current dividend yield. And they're also de-levering a pretty reasonably levered balance sheet. So we think that this is a great opportunity. And by the way, it was trading at 6 times earnings. So I think a lot of people looked at it and they were like, man, this is definitely a value trap. But it was a tobacco business that's extremely stable, right? And when you have a situation like that where you understand the business, you understand the underlying fundamentals, you understand the free cash flow, and then you can see that they have plenty of free cash flow to service the dividend, I think that's a pretty good place to be. We tend to think that, the average company, if they're generating in this environment, so when interest rates change, your yields will change. But if they're generating a 2 to 4% dividend yield, it's probably okay. It's a good place to go look. But then there are obviously opportunities, even up at, like, it used to be a 10% yield. I think now it's about a 7 or 8% because the stock's up so much. But there are opportunities with double-digit yields that can be interesting. It just depends on the underlying company and fundamentals.
I want to talk to you now about some ETFs that are out there. Before we get into Opal's ETFs, because the big one in the dividend investor community, as I'm sure you know, is SCHD. And I mean, this is like the gold standard treasure chest for dividend investors. Everybody and their mother, as I say, always talks about SCHD if you're a dividend investor. What's the hype about this specific ETF? What's your take on it? And I want to follow that question up by saying, you have your dividend ETF. Why should someone choose yours over an SCHD?
Yeah, so we have DIVZ, and we often get compared to SCHD. My view is SCHD does not have a quality focus. We generate a similar dividend yield that's growing faster without participating in what I view to be the more questionable part of the market. So we don't own a lot of shakier regional banks. We're not owning a lot of super cyclical companies, and we're able to generate approximately market-based returns. We have a beta on the S&P of about 0.6, right? So much less volatility than the overall market because we're not investing in what they call the tail of the whip sometimes. It's these names that have a lot of leverage, have a lot of cyclicality, and are going to be whipped all over the place in the economic cycle. Many of the passive portfolios out there, like SCHD, do invest in those parts of the market because they're trying to be broadly diversified. So what we do is we try to protect investors from that psychological shortfall of wanting to sell as soon as the market and their portfolio drops. And we think it provides a better outcome for investors over the long run. Now, one thing that we get pushback on all the time, which I think is absolutely absurd, is people say, well, your fee is higher than SCHD, so I'm buying SCHD because it's cheaper. It's like, okay. So if you had to pay for, whatever product you're looking at, like if you want a Ford Pinto, right? Like, yeah, you can get a Ford Pinto for extremely cheap. Or if you want to drive in something that maybe suits your style a little bit more and you want, I don't know, like a BMW or a Jaguar or something that's nice that serves a purpose, you're going to have to pay a little bit more. For some reason in investment management, there are a lot of retail investors that believe that fee is all that matters. And it's almost like the people in value investing that just focus on the price. I'm going to buy the lowest PE stocks that I can find, right? And we all know that that's a value trap, right? But there are still people that do it, even though it makes no sense. And so when people say, oh, you charge too much relative to an SCHD, I mean, we're outperforming SCHD after the fee. So if that's what you want, if you just want to save money so that you could tell people that you have the lowest expense ratio on your investments, then fine, go buy a bunch of passive that has a lot of cyclicality in it, and you'll perform like the market. If you want something that provides you a better experience, then you're willing to pay a little bit more for it, then that's fine. That's who we've created DIVZ for.
All right, let's go on the flip side of the script, because today and more recently, I mean, we're on fire with covered call ETFs. That's like the next big. I feel like this, for the dividend world, this is like the meme stock moment, right?
It is.
Why not go into the covered call ETFs? I mean,
well, how about the meme stocks that have covered calls, right? They're writing calls on some of the meme stocks, which is absurd. Like you've got them doing like super micro covered call strategy, and it generates a 30% yield, and the NAV drops by 40% a year. So people are excited about it. It doesn't really make sense. I think we've looked at covered calls. We had thought about developing a covered call strategy. Here's the issue. The market tends to go up, right? And the market tends to go up in spurts. If you're selling covered calls to generate a little bit more yield, you tend to cut off a lot of your upside. And so when you look at like the JEPIs of the world, right? Performance in JEPI was amazing in 2022. But this year, it hasn't been that great. If you want the stable like 10% return of JEPI because they're writing a bunch of calls, that's fine. But you're not necessarily getting the market exposure. You're getting that chopped off top of the market exposure. And I think a lot of people miss that. If you actually sold covered calls on the S&P 500 over the last 100 years, you would dramatically underperform the market because the market tends to be up solidly in the double digits, or it tends to be down, right? It's not up like everyone's like, oh, the market tends to be up 10% on average, and so if I sell 10% out of the money calls, I'll be fine. Well, how many times does it actually end up at 10%? It's not that frequently. So if you're selling these calls out of the money, all you're doing is cutting off your upside, And ultimately, you end up with a source of income that tends to be at a higher tax rate. So you're trading capital gains at a low tax rate for call premium that tends to be at a higher tax rate. Doesn't seem like a good trade for me. If you really wanted to generate that income, I think it's better just to sell off a little bit of your portfolio each year in excess of your dividend to generate it the old-fashioned way.
It really is the traditional approach to investing, Warren Buffett-esque. What do you think it is with investors? I don't know if I can even say investors just of today, but like the human nature to remain, I don't know if aggressive is the right word, right? But just an inability to sit still. We got to have our finger on the trigger, ready to buy, ready to sell, next big win. How do we train ourselves just to be patient? Because as even Buffett shares, right? Like the stock market is the vehicle to transfer wealth from the impatient to the patient. But how do we execute on that?
Yeah, I think it's you find durable information to focus on, right? Like if you spend your day watching CNBC and you consider that investing, you're probably doing it wrong, right? CNBC is selling you a pretty short news cycle, right? If you spend your days reading 10Ks and reading company reports, you're probably getting closer to doing it right. And by the way, what does Buffett do? He spends his days reading, annual reports, 10Ks, 10Qs, understanding what's going on with his companies instead of focusing on all the numbers that are flashing across the screen on CNBC or what the Fed's, what's the Fed going to do tomorrow, 25 basis points or 50 basis points? Like all that stuff is kind of meant to, I think it's meant to entertain, and it's not meant to actually help you make informed investment decisions. And so I think people need to focus more on the source of the data and what's the intent of the source of the data, and that will help make smart investing decisions versus maybe making decisions based on some entertainment factor.
So here's one for you in this regard, because it's really hard to find individuals to actually trust, like professionals. Wall Street. I mean, we've been duped by Wall Street so many times. You've worked on Wall Street, so you know the ins and outs of it. How do we know who to trust?
Yeah, I think that's a good question. I think, well, one of the reasons that I think mutual funds are so bad for investors is because so much happens beneath the veil of quarterly reporting, right? So many things can happen in your mutual fund that you didn't even know existed. You end up paying taxes when your fund actually had a down year. You're like, what the heck? How did that happen? Right? And all of a sudden, like, you end up collecting dividends because your dividend manager decided his yield was too low. So we started buying a bunch of stocks before they paid dividends and sold them after they paid dividends, essentially manufacturing dividends, which, most people don't think happens. They happen in mutual funds. Let me tell you, ETFs, every single day, my portfolio is on the website. You could see exactly what's going on. You could see what's being sold, what's being bought. I think that is the closest thing to complete transparency that you can get in this business. And I think that more investors should look to ETFs rather than looking to these opaque structures, which are meant to mislead individual investors. The people who are putting their hard-earned money in these funds, it's meant to mislead them. I don't think that that's a good thing. From a trust perspective, Wall Street hasn't done a great job of developing trust with individuals because of the different things that have happened, whether it be the financial crisis or whether it be SPACs were the most recent revenue generating mechanism for Wall Street. I think if you see people looking to make a short-term buck, it's likely that they're putting their interests in front of yours as an investor. So when I see people who are, creating, investment vehicles, collecting massive fees on them like SPACs, and then taking preferred shares like SPACs, and they do it over and over again, you're like, something's up here. They're probably taking advantage of people. And by the way, most of those SPACs blew up, right? I don't know why the SEC didn't do more about that when it was happening. It was really obvious. But you have to kind of look at what incentives are for the people involved. In the ETF space, why I like it is literally the fee is on the prospectus, on the front of the prospectus. There's no pass through of additional costs. The fee is there. And all the costs to actually maintain that structure are paid by our company, not paid by the investor. In the mutual fund space, they put a management fee up, and then they have the statement of additional information that includes all these other costs, right? And those costs can be whatever, like they put it in the prospectus that nobody reads, right? But then they can escalate as the fund gets bigger. And you see these funds that they charge like a 75 basis point management fee, and the actual expense ratio is 125 basis points. And you're like, how does that even happen? Like, what are they passing through to get to the point where the expenses of the vehicle are almost as much as the management fee? That just doesn't seem fair. It seems like, Wall Street kind of trying to hide the ball from individual investors, and I don't think it's right. So I think ETFs go a long ways in cleaning up that transparency and getting people to a place where, it's very forthcoming. It says exactly what's going to happen, and that's what happens going forward from a fee perspective.
Austin, should we avoid picking individual stocks in that case? Like, should we just go ETFs?
It's a great question. I tend to think if you don't know how to read a financial statement, if you've never opened an annual report before, if you haven't been trained, then the stocks that you pick should be considered as more of fund money than like a long-term investment process. And that's a bit far reaching, because there are some people that don't know how to actually analyze a stock, but they do know that they should just buy and hold for a long term, and things tend to work out very well for them over time. But if you're the person who thinks that you're going to get tremendous investment insight by watching CNBC for 3 hours a day, and you're sitting there buying and selling things based off of what Jim Cramer tells you, the likelihood that you're going to generate the type of performance that you would like to generate is probably relatively low. And I would suggest putting the bulk of your assets into something that's more professionally managed, obviously with a reasonable fee structure that's clear, stated up front so you know what it is. But then, carve off a piece of your portfolio to go play with, whatever it is, Mad Money every night, and get the emotional rush of, picking winners or having a loser and calling Cramer to ask him what you should do with it. That's definitely an approach. I think trying to convince people that they should be doing this themselves when we know that emotions play a big role in it is, it's a little disingenuous at times, because you don't want to put people in a situation that when things go south, they end up hurting themselves from a financial perspective. And I think that's kind of like the downside of things. And we haven't had a big bear market in some time. And so right now, we have a lot of clients who are like, oh, you should own, NVIDIA, you should own, Supermicro and all these things. They've gone up so much, you've just missed out. And it's like, well, but, we've seen in the past these things go up and then they can come back down. It's not a fool safe stock that you're always going to win with. And we'd prefer to focus on fundamentals and companies that have really solid fundamentals but trade at attractive prices.
When it comes, and this one's for all the stock pickers out there, when it comes to picking individual stocks, and I'm guilty of this, back in 2020, everything was on a massive discount. And I had my dividend dopamine hits, right? To get all that passive income, if you will, that I wanted to collect. So I loaded the boat with my portfolio, upwards of like 40 to 50 stocks. It's actually been quite some time and a lot of work trimming that all back down after hearing a Bill Ackman interview and kind of sharing that less is more. And there's not, 50 to 60 quality companies that are really out there that you can win big with. So now here I am today. I'm all trimmed down, but I'm curious to know from your standpoint, if someone is to go pick individual stocks, and let's say maybe even they have an ETF as their foundation, what is the right amount of dividend stocks or stocks in general to actually hold within a portfolio? When does it just become too much? And when is it really risky that maybe you're all in on like one or two?
Yeah, it's a good question, and I don't think it's a number of stocks. And Joel Greenblatt's famous in his books of saying, you get, I think it's like 90% diversification with like the first 8 or 9 stocks, and that's definitely true to the extent that you have 8 or 9 stocks that are uncorrelated. And I think that's what people miss, right? Like right now we have the S&P 500, a third of it sitting in the Magnificent Seven that all have very similar underlying fundamental drivers. There's a lot of risk there. And you could put together a portfolio of 7 stocks, 7 dividend payers that have very little risk because they have different underlying business drivers and they'll perform in different markets. I tend to think somewhere between, we have 25 to 35 stocks in DIVZ. Part of that's to smooth things out a little bit. If you're an individual investor that can deal with the volatility, understand what you own, you really like what you own, you could get by with anywhere between 7 and 15 stocks and be perfectly fine. And it's also really hard to come up with 7 to 15 ideas that you love, right? Like the bigger the stock is in your portfolio, the more conviction you have to have in the fact that it's going to work out, but don't get so in love with it that if something changes, you're unwilling to part ways with it. The other thing we see a lot of is investors who refuse to realize taxable gains, even if it means putting them in a better portfolio. And it's actually quite comical. And my retort to that is always, well, fine, we'll wait till your portfolio goes back to where it was when you bought it, and then you can sell it, and we can put it into something that makes more sense. But in reality, that's not our goal for investing, right? People get too focused on the secondary objective, which is reducing taxes, that they forget that the primary objective is generating attractive risk-adjusted returns. And so they end up not focusing on the primary because they're so focused on something that, at the end of the day is a fact of life. You have to pay taxes if you're generating attractive returns.
Uncle Sam will be reaching in your pocket for his tax collection. Put it that way. Austin, if you were to grab a beer or go out to dinner with one of your icons, heroes in the investment space, whoever that may be, I'm curious to know who would it be and what would the conversation be? What types of questions would you ask?
Yeah, obviously, I think Buffett is like one of the ones that most people would want to talk to. I think that he's in a unique situation because he's actually had a very captive portfolio to manage for the last 50 plus years. The one investor, he's actually local, and I haven't met him. I'd love to meet him at some point, is Rajiv Jain. He actually has quality dividend portfolios, and he's done an amazing job of adapting to the market. And I think he's got some analogies that he's, mentioned on podcasts that I think are really insightful. Kind of like, and I was victim to this before I really started listening and understanding what he was talking about and started managing active ETFs myself. But he's like, investment management is the only place where people say, I didn't perform today, this week, this month, or this year, but wait till next year. He's like, if you're a professional basketball coach and you leave your best players on the bench and you've got, the worst players on the floor and you're getting your butt kicked week in and week out, and you told your GM, but wait till next year, we'll be much better because I'll just take these guys off the bench and I'll put them in, you would get fired, right? And so investment management is the only kind of profession where people are like, yeah, I'm right, everyone else is wrong, you just wait and see. And I feel like that's a really arrogant way of approaching the markets. And there's this, it's a delicate balance, right? You don't want to be like swinging back and forth with the market, just buying and selling what's working. But you also don't want to be burying your head in the sand like an ostrich saying like, I figured it out and no one else knows what's going on. I think Rajiv has done an amazing job at GQG of actually building a business around focusing not only on kind of the underlying fundamentals, but how those underlying fundamentals are being recognized in the market today and participating in the parts of the market that are benefiting.
Let's talk a little bit about Opal Capital. What's the deal with the name? How'd you come up with it? How did it get started?
I wish I had a better story. I don't. So we were we were we were starting an RIA out of an SMA business that we had created in the ETF business, and we started it. We spun it out of another RIA, and we were looking for a name. And there, when you look at RIA names, literally almost every name has been taken. There are literally hundreds of thousands of these things in the U.S. And so we're trying to come up with like a decent name. And my wife and I, we went to the west coast of Florida. We live on the east coast for just a quick trip in 2021, trying to get away from some of the COVID stuff and just relax. And we stayed at this Opal Grand Resort. And my wife was like, Opal's a pretty cool name. And so I was like, yeah, I'll take a look. And, Opal actually has some like meaningful context when you think about it. It's like a gem that's kind of underappreciated. And I was like, that kind of makes sense when it comes to like picking stocks. And by the way, there isn't really an Opal Capital that's out there. So maybe it'll make sense to name our RA Opal Capital. And so we actually just went with it from there. We had 3 or 4 other names that were not nearly as good. And Opal kind of stuck.
I'm gonna say it's actually quite a good story, specifically because you're focused on the dividend stocks and dividend investing. Talk about underappreciated gems of the market. A lot of the dividend stocks are exactly that. I want to go in the direction of trends and ask you some of the trends that Opal Capital is looking into right now, just based on the state of the market, where we're heading. I mean, as you shared earlier, right, Powell's going to come out with some type of rate cut. And when we get that news, the market's going to react. But a year from now, 2 years from now, where are we going to be? What can we expect? What's Opal doing?
Yeah, so I think the more important thing, not 25 or 50 basis points, more important is, are we on the path from 5.5 down to 3? Are we on the path from 5.5 down to 2? And what does that mean for where we are in the economic cycle? And so it does seem like the economy is slowing quite a bit. And it seems like with rates coming back to something that's more normal for the last 15 years or so, I don't know that that's normal. Like, I don't know that that's the new normal, to use the PIMCO term. But more normal for the last 15 years, dividends are going to be more compelling. So we're a bit more focused on some of the dividend payers, some of the consumer staples that we think have been kind of left out to pasture because people think that GLP-1s are just going to change the world. I think GLP-1s can change the world, and Coke and Pepsi can continue to sell a lot of product, and maybe they'll sell smaller cans, right, at the same price, and the price per ounce is going to go up, and all kinds of different things that happen with these companies. But I do think that consumer staples are a good place to be. I think that utilities are a uniquely good place to be right now. We've been in utilities for 18 months, probably about 10 months too early. But we were there because we saw the energy demand spiking from artificial intelligence. It seems like it took the market quite a while to figure that out. But as soon as everyone started focusing on the Fed reducing rates, they all of a sudden realized that utilities are going to be a beneficiary because you get that bond-like stock boost, but you also get increasing demand for utilities. And then finally, depending on what happens with outcome of the election, which is something that people love to, I think, speculate on with the portfolios for the wrong reasons. But depending on what happens, we could see a tailwind for healthcare names that have really been dinged up over the last 3 or 4 years. So we think there are a lot of opportunities in more stable parts of the market that tend to pay higher dividend yields. The first half of the year, we were actually in lower yielding categories. So we were focused very much on some of the chip names that are supplying some of the data center spend. We've been rotating out of those names into the more traditional areas as we've seen both prices go up dramatically in those stocks, but we're also seeing the potential for a slowing economy making some of these more stable companies more attractive.
Can you give us some of the names, like 2 or 3 names that Opal has been really keen on looking more into?
Yeah, so I mentioned Coke and Pepsi. Those are some recent buys. NextEra Energy is the largest holding in the portfolio. A name that I referenced earlier in the podcast was British American Tobacco. It's actually an ADR with BTI. It's probably the highest yielder in our portfolio. It's a unique situation because it's actually growing, and it was trading for about 5 or 6 times earnings. Now it's trading a little bit higher than that, but it's still a pretty significant discount. We think that Verizon could be really interesting from here. So it's really, right now we're looking for companies that definitely have that economic stability through the cycle, as we think we could be nearing kind of the tail end of the growth side of the cycle. So it's some protection for the downside, but also these names tend to do far better in a declining rate environment than some of the more growthy names do. So we think it's a unique kind of situation for them.
Sure. Now, in this case, we have British American Tobacco, we have Verizon, a bit more higher yield stock plays. Now, would we argue that maybe there's a bit of stagnation in terms of capital appreciation with these companies, or do you think they have, really bright futures ahead of them in terms of appreciation?
Well, look at the price, right? In a market that's trading at 21, 22 times earnings for the S&P, you can buy companies that historically traded a premium to the market, and they have single-digit PEs or low double-digit PEs, right? So if you're Verizon, and let's say you just eke out like 3 or 4% earnings per share growth per year, right? Even if you trade at 12 times is not where that stock is historically traded. There's definitely some pessimism around it. So you get that 3 or 4% compounding over time. You have a really nice yield. And then all of a sudden people start to realize Verizon's not as much of a dud as they think it is. And you can get to a place that's really attractive total return. You could get to a nice solid double-digit total return pretty quickly from that place. We think it's very similar with British American Tobacco. They're kind of boring, right? They look like bonds. They kind of are like bonds, but they're growing. And they're bonds that are growing in a declining interest rate environment. So we all know what happens to the price of bonds when interest rates go down, right? I think that there's the potential for these stocks to appreciate in a similar fashion.
Sure. British American Tobacco, the trend seems to be that more and more people are weaning away from smoking and tobacco. Is that a scare?
You're missing the biggest part of the business, right, is the alternative or the harm reduction. So as you look for vaping, as you look for different products that are less harmful for the smoker, but still a way for them to consume nicotine, that's the main driver of the business. It's a much higher margin piece of the business for them. So I think the scare of kind of traditional cigarette business going away, like that's a misleading, I think that's the wrong perspective, right? First of all, that business generates a ton of cash, and it's got a ton of people that are somewhat addicted to the product, but they continue to, participate even though everyone is well aware of, the negative ramifications from smoking. But that business is actually funding a new business that has a new delivery mechanism for tobacco that is a higher margin business, a very rapidly growing business, and is quickly taking over the cash flow generation of the broader company. And so I think that over time, that's going to become much more apparent, and people are going to be less focused on, hey, cigarette smokers are, dying away, and more focused on, the people who are going out to the bar and vaping and, consuming tobacco in different ways. So I don't think people are going to all of a sudden become like anti-tobacco. They've had the opportunity for the last 30 years to do that. They still seem to want to consume tobacco, and to the extent tobacco companies can find less harmful ways for them to do that and make more money on it, I think that's generally a decent business proposition.
Sure. I want to ask you what you think the most common mistake everyday average Joe investors are making.
That's a good one. I think it's more emotionally driven investment. So see a stock go up, buy the stock, see a stock go down, sell the stock. When I talk to people, that seems to be their disposition. People tend to want to talk about this, like they're looking to invest in stocks to have something to talk about at the bar or at like, a party with friends instead of looking to invest in stocks to buy things at attractive prices that are going to compound in growth over the long term. And so I think if you find yourself like trying to convince people that you're some great investor because you owned whatever, I don't know, because you owned Amazon in 2020, right? Like I just don't think that that's necessarily the recipe for success in investing. I think it's successful investors tend not to share a lot about what they're doing. They tend to just go about their business and let the results take care of themselves. And I find that many retail investors who are really into it tend to want to go talk about it, right? And tell everyone like about their great stock pick. And I think if you're walking around telling everyone about the stock that just went down, that you're super happy it went down so you could buy more, that's probably a good trait. But I don't think that going around saying like, yeah, I'm a genius because I bought, Google when it was, at whatever, when it was 10 times lower. I don't know that that's necessarily the sign of good investing as much as it is like someone who's riding momentum.
Sure. I want to go and talk about your career real quick because you've had a heck of a career, still pumping, still going. But I mean, tremendous student, got yourself then to Goldman, PIMCO. Now you're obviously the founder, CIO there of Opal. Incredible track record. I want to know your best investment that you've ever made, and it doesn't even have to be when you got into the field of finance. I mean, it could have been well before.
Does it have to be a stock?
It could be any investment that you've made that you've seen a tremendous profit from.
So it's actually pretty funny. It was not from that long ago, and I was talking to my brother recently, and I was like, man, I think this might be the best investment I've ever made. And I've made thousands of investments in my career, but in 2020, my wife and I got fed up with COVID kind of rules in Southern California, and so towards the end of the year, we drove across country to visit my in-laws for the holidays in Florida. And we ended up staying here. We were like, you know what? It's kind of nice being on the East Coast. And we bought a house we put the money down at the end of 2020. And it was July 2020 pricing that we got on the house. And obviously, real estate, you can get a fair amount of leverage on. So I'm not advocating for leverage on investments. However, the house was finished in March of 21. And so the market had already appreciated dramatically. We didn't really know. But then my wife ended up getting a job in Miami. And so we put the house on the market in the beginning of 22. And the actual price of the house had nearly doubled. So our levered return over what turned into exactly a 12-month time frame, because we ended up closing just after we hit a year, was a pretty significant annualized return. So that's probably the best investment that I've made. It was a relatively short time frame. If you're looking for an actual stock investment that has a higher annualized return, we actually bought, it's a airline, it's an affinity company with Air Canada called EMEA. You could buy preferred shares in it a few years ago at about 45 to 55 cents on the dollar. We ended up buying those shares, and an acquirer came in and bought them out at par within, I think it was a quarter of us doing that. So timing was a little bit lucky, but we did generate some pretty high returns from that investment as well.
The last question I have for you, it's a loaded one. Also my favorite question to ask every master of the market who joins me here. Austin, if I were to give you $10,000 right now, which stock, individual stock, or you can go ETF, wherever you want to go with it, where would you invest it and why?
What's your time frame?
As long as you want, preferably longer term.
Then put it in DIVZ. Come on, DIVZ, the ETF that I manage. I would look for the top five in our holdings if I was looking to get a really concentrated return, which is going to own NextEra. It's going to own British American Tobacco. You're going to own Verizon and a handful of companies like that. I think that that's a pretty attractive place to be over the coming months and quarters as we see this rate reduction cycle start to pick up steam.
Austin, I want to say thank you for joining us on Masters of the Market. It's been incredibly insightful. And I want to say I think you've actually been the first Dividend Specific CIO on with us. So that is huge. Investors, if you're not aware of Opal, go check them out. They have tremendous ETFs for you to dive into, especially if you're looking really for dividends and passive income. This is your opportunity to jump over to Opal and, again, get your hands on some good ETFs. Austin, thank you again for joining us on Masters of the Market. And investors, until the next one, we will see you all there.